Hello and welcome to the latest Wealth Advice market update recorded on the 7th of November. As always, we're going to look at the markets and think about the factors that have affected the markets in the last few months and also look forward to the things that we're talking about with clients. In general, when I've been catching up with clients recently, there's been lots of positive news for the markets, and this has been seen because we've had 6 months of consecutive growth in the US stock market. We've also had reduced global tensions, and we've also had, moving forward and progress with things like America and China. So when we look at the performance of the market since the start of 2025, we can see that positive message that I'm really reiterating towards the end of the chart there. We've seen the volatility that was caused primarily by Trump's tariffs previously, and anyone who's been looking at their valuations recently will have seen it's been a bit more smooth sailing recently, and we hope that continues. Rightly, clients have been asking questions in relation to the budget, and we have picked that up in a separate video, but we'll be touching on that as well in today's update. When we zoom out on the charts and look at the performance over 5 years, again, when we look at the equity markets, the S&P 500, the MSCI World and the FTSE 100, we can really see that positive trend through the year. Again, there's periods of volatility which we always highlight, which is why we have the need for diversification. But those clients who are in a balanced portfolio with 40%, 50% or 60% in equities, they will have seen strong performance, especially when they're looking at their recent valuations. What specifically has impacted the markets in the last month? Again, we mentioned those US markets. They've been driven by tech stocks and they've had better than expected earnings, and that's focused on the likes of AI and the cloud computing growth. We've had a number of clients sort of ask questions about that recently, and there tends to be a focus on saying, is it a bubble or is it something that's sustainable for the long term? I was recently in America for a friend's wedding and I was in a driverless taxi. Again, it's how these things are brought forward and how they are embraced into different industries and different sectors. So I found that experience really safe, really interesting. And I think, going forward, that's where we're going to see future growth. It's not just going to be the tech companies, it's going to be how those other companies can innovate and be more efficient. When we've asked fund managers and economists about the idea of, could we be heading towards a bubble, their views being that these big companies that are investing significant amounts of money are doing it in a sustainable way and they're not borrowing to have these growth and have these development. So therefore, unlike previous things like the dot-com bubble, this feels a lot more sustainable. Rightly, there will be a time when a company misses an income statement or a target and there is a bit of wobble, but as long as we have a diversification within a portfolio and as long as there's other areas such as the UK, Europe, Asia that can take things forward, then we don't feel there's anything to worry about currently. When we look at the US, we've also had a reduction in interest rates. There was a cut of 0.25%, and Jerome Powell sort of commented that he had a cautious tone, and during the press conference he said there will be difficult outlooks in relation to things like job and inflation, and a December rate cut therefore is not a foregone conclusion. In general, we've been talking about inflation a lot and interest rates in terms of our long-term market updates, and we know that inflation is higher than the targets for both the US and the UK, but we're tending to find that inflation is a bit stickier and it's slower in terms of coming down. When we look at US and those global relationships, there's been positive relationships between the US and China. Trump met the president of China last week for the first time since Trump's return to the White House, and they agreed a few things in relation to the tariffs. Chinese agreed to pause the export controls in relation to the precious minerals. That's really important because they're used in the AI supply chain. And in exchange, the US agreed to roll back some of their restriction on Chinese companies. So that was one of the potential issues that could have caused market volatility going forward. So as they become slightly friendlier and as Trump softens his view towards the Chinese, that's certainly positive. The US agreed to halve the fentanyl-related tariffs on Chinese goods. So again, this temporary truce sort of allows the strategic tensions to be resolved slightly and to work towards a more long-standing relationship. So as we see in the markets always, uncertainty is what causes volatility. So whilst we haven't got the conclusion now, because they are starting to talk more and engage more, that is having a positive impact in the short term. When we think about the UK, clients are very much focused on the budget and asking us questions on what we expect to happen. The main thing that we're seeing is that the impact and potential taxation changes, we don't expect that to have a large impact on the portfolios because the UK market has such a small percentage of our overall global portfolios, given the sort of strength that we've seen from it. But when we talk to fund managers, economists about the potential taxation changes and clients, they're interested to see how the Labour Party might go to balance the books and try and reduce that deficit. Everyone will know that with the 2024 general election, the promise was not to increase income tax, national insurance or VAT for the working people. However, speculation is increasing that Labour may have to raise taxes in this area in order to try and get that roughly 30 billion deficit under control that Rachel Reeves is really focused upon. In relation to the interest rates, the Bank of England held interest rates at 4% as they've judged that inflation in the UK has peaked. If you look at this target here, again, you can see on the graph there that UK interest rates, has started to come down, but it hasn't come down quite as quickly as might have been expected. And that comes back down to that element of inflation being sticky. The current figure is 3.8%, which is nearly double the Bank of England's target of 2%. But the Bank of England Governor Andrew Bailey said rather than cutting interest now, he would prefer to wait and see if price rises continue to ease this year. We've spoken to a few fund managers on this topic, and some people say that 3% might be the new 2%, but equally we are seeing a trend where inflation is coming down. It's just going slower than expected. The Bank of England said evidence suggested in the quarterly update on the UK economy that there's no sign of increasing consumer confidence, and consumers remain focused on value and prefer saving to overspending. So that's one of the factors that's impacting, one, the economy, but also the decision on interest rates and inflation. People are often focused on things like, food inflation and energy inflation and price rises there. So again, we'll be looking at those baskets of goods and services to see if there's certain elements that are pushing inflation going forward. For those who are wondering, what Rachel Reeves will do in relation to the budget and what's the problem that she's trying to fix, the UK government borrowed 7.2 billion more than the forecast in the first 6 months of the fiscal year, and this really highlights the challenge that the Chancellor has of trying to get public finances back on track in the upcoming budget. The budget deficit climbed to 99.8 billion, overshooting the 92 billion forecast by the Office for Budget Responsibility in March. These higher borrowing costs and some U-turns on welfare cuts and productivity downgrades means that the Chancellor essentially needs to find 35 billion just to restore the 9.9 billion buffer that she left against her binding fiscal rules. And those are all figures from Bloomberg Economics, but that's the figures that people are talking about in the press at the minute. That's really created this uncertainty in relation to taxation. As I said earlier, we've recorded a specific video and we've done a podcast episode looking at where the taxation might change. So I won't go through all of that at the minute, but I think in reality, people are going to be interestedly looking to say, how are they going to be impacted? And we'll be doing an update straight away after the budget to let our clients know, what we think of the changes and where they may be impacted. I think, it's likely that the personal allowance and tax rates are likely to be frozen for longer. The same might be applied in relation to inheritance tax. And there might be some tweaks to the likes of national insurance and income tax, but we'll be doing a full video to cover those bits. So I've already talked through those charts on market performance, but overall, it's a really strong finish to the year as we've seen on these charts. And in terms of the drivers being, US markets, political, a bit more stability and less global tension. And then the main focus for us at the minute is looking at the UK and the budget to see how our clients' taxation positions may be changed. As always, if you've got any specific questions, please get in touch and we look forward to catching up with you soon.